If I tell you there's a way to invest in SpaceX and OpenAI, two of the hottest tech giants on the planet, even though they are not publicly traded, would you jump at the chance? Well, a closed-end fund called DXYZ holds stakes in these two cutting-edge companies, and its price soared from $11 to over $70 in just a month. Sounds too good to miss, right? But hold on, this could be the FOMO trap. FOMO stands for fear of missing out. And if you feel the urge to buy in just because the profit looks so appealing, you are falling into the same mistake that's burned countless new investors. Today, I'll explain why chasing hype can lead to steep losses and why investing in DXYZ right now might be riskier than you think, especially if you are just starting out. Before we dive deeper, a quick note. I'm not a financial advisor. This is just my personal perspective. And through the videos on this channel, I aim to help you develop your own solid investment strategies. Let's get started. So, how exactly does chasing hype backfire? It often starts when the promise of massive returns overshadows our judgment, making it easy to forget the basics. Fundamentally, making a profit always hinges on four things: what to buy, when to buy, how much to invest, and when to sell. Let's walk through each step to see why the fail rate is so high for beginners looking to cash in on hot stocks. The first factor, choosing what to buy. Picking the right stock isn't just about luck, it's genuinely challenging. Take professional fund manager, for example. They have access to extensive resources like a large research team, advanced analytical tools, and a significant budget. Despite all these advantages, many struggle to consistently outperform the S&P 500. According to the S&P Indices versus Active scorecard, around 80% to 90% of actively managed funds underperform the index over a 10-year period. This shows that even with top-notch expertise and resources, beating the market consistently is incredibly tough. So what does this mean for us everyday investors? If professionals with all their tools and knowledge can't consistently pick winners, why should we think we can? I learned this the hard way during the GameStop frenzy in 2021. I decided to buy 3 shares at different points, averaging $218 each. Why only 3 shares? Well, my wife had to step in and limit how much I could invest after some past losses. If you want to hear more about how I burned thousands in my first year, check out my previous video here. Back to the GameStop story. The hype was hard to resist, so I pulled the trigger with my limited funds. Within a week, the price plummeted to $66 per share, and I ended up losing $450 in just a week. Trust me, not knowing what to buy and blindly chasing these trends can lead to poor investment decisions. With so many options and so much hype, it's easy to get lost and make impulsive choices. Another tough hurdle for new investors is figuring out the perfect moment to buy. Even professional traders struggle with this. And for beginners, identifying those hidden gems early is almost impossible. Take GameStop as the example again. In July 2020, the YouTuber Roaring Kitty began advocating for GME, recognizing its potential before it caught wider market's attention. However, most investors only noticed the stock when mainstream media started highlighting its explosive rise in January 2021. By that time, the stock had already surged dramatically, making it difficult for those who joined later to profit without paying a premium. That's exactly when I jumped on the ship, hoping to ride the wave, only to watch my investment tank alongside the hype. Some might say that Roaring Kitty wasn't a well-known figure initially, which limited his influence. Instead, tracking the moves of prominent investors can be advantageous because their actions are documented through publicly available information. That is true. For example, 13F filings provide detailed reports of institutional investors' holding every quarter. You can follow investors even like Warren Buffett and figure out what he has bought and sold in the past few months. However, there's a significant drawback. 13F filings are only released up to 45 days after the quarter ends. This lag means that by the time we access this information, the market has often already moved on, and those hidden gems may have already picked or declined. To put it simple, why do top investors feel the need to share their million-dollar strategies for free? If we are consistently behind in spotting the hot stocks, is it even worthwhile to try and catch the trend at its peak? So, take extra caution before you hit the buy button. Now let's dive into the next common pitfall, deciding how much to invest. The allure of the big win can lead us to make impulsive and irrational decisions, often causing us to overlook the associated risks and invest more than we should. George Soros, a billionaire investor, emphasized the importance of position management when he stated, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." This highlights the critical needs to manage your position wisely. However, not everyone follows this wisdom. Many jump into investment without understanding the basics of position management, driven by the fear of missing out on opportunities. A great illustration of this is the story of the Wall Street Bets user Control the Narrative. He managed to leverage his $2,000 account 25 times, exploiting a loophole in Robinhood that has since been fixed. With his amplified buying power, he placed a hefty $50,000 bet on put options for Apple. When Apple stock moved against his bet, he lost the entire $50,000 in just a second. This starkly reminds us how poor position management can lead to devastating losses. So what can we learn from this? Always ask yourself, how would I feel if I lost all the money I plan to invest? If the thought of this potential loss makes you feel heartbroken or overly stressed, it's a clear sign that your planned investment exceeds your max tolerance for risk. In such cases, simply don't invest that much. Alright, let's talk about the last tricky part of chasing hot stocks, knowing when to sell. Successful investors always have a game plan. They set price target or stop loss orders based on thorough research and analysis. Even if the stock doesn't move the way they hoped, having that exit strategy helps them stay disciplined and control the scale of losses. It's like having a roadmap that guides their actions in the market. But for beginners, they often lack that kind of plan. Without a defined exit strategy, emotions like fear and greed can take over. This can lead to rash decisions, like holding onto a stock for too long or selling too early based on how they feel in the moment. Again, let's use GameStop in December 2020 as an example. Imagine you bought in when the stock was $5 a share. Fast forward a month, and your investment skyrocketed to 16 times its original value. Isn't that insane? But then you start thinking, I can push it to 20x or even 30x. So you hold on a little bit longer. Next month, the gain dropped back down to just 3x. Now, do you keep holding, hoping for another surge, or do you sell and lock in your profit? Then in March, GME spiked again to $66 per share, even crazier than the wildest plot in the movie. This example really shows how your profit can swing wildly depending on when you decide to sell. But think about this, what if you bought in at $81 and held onto your shares until today? You'd still be looking at a 60% loss. But if you had sold when it hit $66 a month later, your loss would have been much smaller. It really underscores how crucial it is to know when to exit a position. Even if you've made all the right moves up to that point, selling at the wrong time can still lead to big losses. Now you see how hard it is to win by chasing a hype stock. Finding the right ticker, getting in at the right time, keeping your investment sizes reasonable, and cashing out at the right moment. You have to get everything right to eventually turn a profit. Let's be real, what are our chances of consistently winning this game? Plus, hype stocks are super volatile, which means the risks are way higher. Just one wrong move and a big chunk of money could just disappear. That's why if you are new to the investing world, it might be best to just stay away. Don't let FOMO cloud your composure and judgment. Now let's get back to DXYZ. Why buying it now is a bad idea. SpaceX makes up about 40% of DXYZ's net asset value. Now, based on its last report released in June 2024, using the value of SpaceX share it holds at the time, DXYZ's net asset value was only about $5.50 per share half a year ago. Now let's assume SpaceX share value doubled over the last 6 months. This would only bring fund's net asset value to $7.22 per share. But DXYZ is trading at over $50 a share when I'm filming this video. That's a whopping 700% premium. If you don't do your research or don't understand these numbers and just choose to get on board regardless, how much money do you think you can actually make from it? Of course, the stock market isn't always rational. Sometimes, stock prices can rally beyond what makes sense. If you think you can strike it rich by chasing the latest hype, here's my honest advice. Dip your toes in with just 5% of your investment fund and see how it goes. I know this might sound surprising since I've been talking about avoiding hype stocks all along, but I also believe that in the investing world, making a few unforgettable mistakes is part of the learning process. It's like those life lessons our parents gave us. we might not always listen, but we end up learning the hard way anyway. If you have a different thoughts on this topic, please leave your comments below. And if you found this video helpful, make sure to hit the like button and subscribe for more content like this. Happy investing, and I'll catch you in the next one.